You've got $1 million idea, but your bank account is sitting at zero. You hear about Silicon Valley startups raising tens of millions, but where does it actually start? Welcome to the world of pre-seed, the germination stage. This is where dreams first get a price tag. In today's video, we're breaking down exactly how U.S. startups kickstart their financial engines. 1. Startup fundraising, the pre-seed phase. What is pre-seed, anyway? Pre-seed isn't a formal funding round with stacks of legal paperwork. In the States, it's often called the conviction or trust stage. You don't have revenue yet. You might not even have a finished product. Typically, we're looking at anywhere from $50,000 to $250,000. Your sole mission right now? Turn a napkin sketch into a working prototype. What are investors looking for? Why would anyone hand over six figures for something that's just an idea? In the U.S. market, it boils down to one thing: execution. Pre-seed investors aren't looking at balance sheets. They're looking at the founding team. Who are you? Do you have founder market fit? Do you have the grit to survive the trough of sorrow? If you don't have a rockstar team yet, you at least need an MVP, a minimum viable product, to prove that someone actually wants what you're building. Where does the money come from? There are three primary sources for pre-seed capital in the U.S. FFF. That stands for Friends, Family, and Fools, the people who believe in you blindly. Angel investors. These are typically former CEOs or wealthy pros looking for the next big thing. Equity crowdfunding. Platforms like WeFunder or Republic, where you can raise capital directly from the community. The secret weapon, the safe note. If you want to build a startup in America, you need to know this acronym, SAFE. It stands for Simple Agreement for Future Equity. Why is it a game changer? Because at the pre-seed stage, it's almost impossible to say what your company's worth. A SAFE lets you take the cash now and kick the valuation conversation down the road to the next round. It's how U.S. startups close deals fast without getting bogged down in legal fees. Surviving pre-seed is like successfully igniting a rocket engine. You aren't in orbit yet, but you've finally cleared the launch pad. In our next video, we'll dive into the big turning point, the seed round, where the million-dollar checks start rolling in. Hit that subscribe button so you don't miss out on the journey of conquering startup finance. So, are you ready to plant the seed for your big idea? 2. The seed round, when the millions arrive. The transition, congrats. You survived the pre-seed survival phase. Now the real game begins. Welcome to the seed round. In the U.S. market, this is the moment your idea stops being a sketch and starts becoming a machine. You're no longer asking for a few $1,000s. You're hunting for millions. Let's dive into what it takes to catch the eye of serious venture capitalists. The big shift, faith versus growth. At pre-seed, you were selling vision. At the seed stage, you're selling growth. Silicon Valley investors are going to ask you one thing. Do you have traction? Traction is the hard evidence. Month-over-month user growth, early revenue hitting the books, or at least signed letters of intent, LOIs, from major clients. A typical U.S. seed round usually raises anywhere from $500,000 to $2 million, with company valuations often swinging between $5 million and $10 million. Who's signing those million-dollar checks? It's usually not friends and family anymore. Micro VCs, smaller venture firms that specialize in hunting for rising stars. Top-tier accelerators, think Y Combinator or Techstars. Getting into these is like getting into the Harvard of the startup world. Syndicates, groups of professional angel investors who pool their capital to back high-potential projects. Where does the money go? Don't make the mistake of thinking a fundraise is a payday. In the U.S. startup scene, seed money is all about velocity. Most of this capital goes into two buckets. First, hiring top-tier talent, the engineers and growth hackers who will polish your product. Second, customer acquisition. Your ultimate goal at the seed stage is to prove your business model is scalable. You need to show that if you put $1 into marketing, you can pull $3 out in revenue. The valuation trap. A crucial financial warning for the U.S. market. Don't get greedy with your valuation. Why? If you set the bar too high and your growth doesn't keep up, you'll hit a down round in your next phase. That's a disaster. It kills investor confidence and can send a startup into a death spiral. Remember, valuation is a double-edged sword. The seed round is the ultimate stress test to filter out the future unicorns. If you can close this round, the path to Series A and those tens of millions is wide open. As you can see, startup finance isn't just about numbers. It's a high-stakes chess game. In our next installment, we're heading into deep water with Series A, the hypergrowth phase. 3 on Series A, the big leagues, the leap. If pre-seed and seed rounds were like learning to swim in a pool, Series A is when you officially head out into the open ocean. In the U.S. market, Series A is no longer about promises, it's about performance. The data does the talking now. Are you ready to handle a check for $10 million to $30 million? Let's look at just how high the bar is set by top-tier Silicon Valley firms, from vision to metrics. At Series A, investors aren't just looking at the fire in your eyes. They're looking at your KPIs, key performance indicators. In the States, to close a successful Series A, you typically need an ARR, annual recurring revenue, of at least $1 million to $3 million. They're going to perform deep due diligence on your unit economics, specifically your CAC, customer acquisition cost, versus your LTV, lifetime value. If your LTV isn't at least 3 times your CAC, the door to a Series A is going to be very hard to open. Enter the whales, the big VCs. Who leads these rounds? We're talking about the blue-chip firms, Sequoia Capital, Andreessen Horowitz, A16Z, or Accel. Unlike angel investors, these VCs will take a seat on your board of directors. They don't just bring capital, they bring a massive network, global strategy, and, sometimes, intense oversight. Series A is when you have to learn to work alongside the sharpest financial minds in the world. The growth at all costs. Dilemma. What do you do with tens of millions of dollars? You pour gasoline on the fire. Your machine is already working. Now you need the fuel to expand globally, acquire competitors, or build out a world-class sales force. But be careful. This is also where your burn rate becomes a make-or-break metric. In the U.S., many startups collapse right after their Series A because they fail to manage their spending as they scale. The reality of dilution. Here's a financial reality check. After Series A, founders usually no longer have absolute control. Your ownership will be diluted, typically by another 20% to 25%. However, remember the golden rule of Silicon Valley. 10% of a $100 million pie is much better than 100% of a $0 pie. It's all about the mindset of sharing equity to build massive value. Conclusion. Once you clear Series A, you're no longer just a startup, you're a scale-up. You're on your way to becoming a market force. But Series A is just the beginning of the alphabet. Series B, C, and the ultimate goal, the IPO, are still ahead. Want to know where the journey goes next and how American founders become overnight billionaires when they ring the bell on Wall Street? Stick around for the next one. 4. The exit strategy, how billionaires are made. The intro. Building a successful startup is hard, but knowing when to walk away is a masterclass in financial art. Have you ever wondered how American founders become overnight billionaires while their companies are still burning millions of dollars a month? The answer lies in the exit strategy. In this final installment of our series, we're exploring how the American dream finally gets cashed out. When is the golden moment to sell? Selling your company isn't a sign of failure. In Silicon Valley, getting acqui-hired or bought out by a tech giant is seen as a massive win. The golden moment usually happens when you own a proprietary technology that a corporation is starving for, or you've captured a user base they simply can't build themselves. In finance, sometimes selling early yields a much higher ROI, return on investment, than grinding it out all the way to an IPO. The liquidity event. You need to understand a critical term, the liquidity event. Until an exit happens, all your wealth is just paper money. It's only when the M&A or IPO occurs that those numbers turn into cold, hard cash in your bank account. However, in the US, founders are usually bound by a lockup period. This means you can't dump your shares immediately. You typically have to wait 6 to 18 months after the IPO. It's a safeguard to protect retail investors from a sudden price crash. Begin with the end in mind. The most successful US startups plan their exit from day one. They build transparent financial systems and rock-solid legal structures starting at the pre-seed stage so that future audits and due diligence are a breeze. The golden rule of startup finance? Don't wait until you're burnt out to find a buyer. Build your company to be bought, not sold. Make it so attractive that buyers come to you, even if you plan on running it forever. Series finale. The journey from a garage-based idea to ringing the bell on the New York Stock Exchange is a grueling path, but the rewards are unparalleled. I hope this four-part series has given you a bird's-eye view of the U.S. startup landscape. Remember, finance isn't just about dry spreadsheets. It's the language of freedom and the vehicle for changing the world. We've covered the four major milestones, from the first faith-based dollars in pre-seed to the growth engine of the seed round, the high-stakes scale of Series A, and finally the ultimate goal of a successful exit. The core lesson. The biggest takeaway, startup finance isn't just about the money, it's about strategy. If you manage your cash flow effectively and maintain the trust of your investors, no dream is too big to achieve. The call to action. Thanks for sticking with me through this entire series. If you found this valuable, hit that subscribe button to join me as we conquer more real-world financial strategies. Best of luck on your founder journey. Go make it happen.